$300 were Ray Dalio's savings as a young kid in the 60s. With that money, he bought shares of Northeast Airlines at $5 a share. After a merger from the company, he tripled his investment and successfully predicting every significant event in the market's history. The man who went from managing $300 to $150 billion has many secrets to share. Let's dive deep into the 7 unique rules you must know from Ray Dalio. But first, subscribe to Market Magnets and click the notification bell to not miss any of our following videos. Number 1. Take a look at the broad internal and external order. A Chinese philosopher once said, "The long-divided empire must unite, and the long-united must divide." The same goes for bull and bear markets, and the same also goes for foreign relationships between countries that define the market's volatility. Ray Dalio has over a half-century of experience in measuring the market's timing, and he knows when there are peaceful and profitable times of sustainability, and when to pull out his money when the darkest days of an incoming crisis are just around the corner. For Dalio, it is evident how countries at war waste resources and human lives fighting. Then living standards decline, and the market too. When countries have conflicts against each other, that's the external order. In March 2022, Yemen's rockets and drones struck an oil deposit in Jeddah and other facilities, sending shock waves throughout the oil market for several days, increasing the volatility and panic from investors. Ray Dalio classifies 4 types of war from which countries can break the external order: trade/economic war, technology, capital, and geopolitical. The same goes for internal conflicts. Ray saw many incoming crises beforehand because he identified when some people contested the validity of elections, expressing animosity towards the other party. That is the first sign of a bear market, when the internal order starts to crumble, and all the stocks start to go south on most portfolios, unaware of what's going on. Before the incoming crisis of 2020, Ray saw a lot of polarization in the US. Survey data on voter sentiment showed 55% of Republicans and 57% of Democrats viewed the other as immoral. By the time the health crisis hit, the inner workings of society were already unstable, and the market took a massive hit. The first step toward financial success is identifying these signs and understanding how the internal and external order works. By doing that, you can get ahead of the market's most significant moves before all the panic about buying or selling starts filling media outlets and investors' advice. The best way to see it is by applying the next piece of advice from Ray Dalio. Number 2. Keep it simple. Investing money is already complicated, and there's nothing more challenging than keeping an eye on the continuous motion of money around you. It can affect the market and your portfolio significantly. Any Sunday, while the market is closed, there can be an event that wakes the stock market up with a black swan on Monday morning when it reopens. Keeping your money invested always takes immense emotional control and discipline. The worst you can do is surround yourself with information all the time to predict the market's next move. That's why Ray Dalio knows it's important to simplify, simplify, simplify. Someone said that any damn fool can make it complicated. It takes a genius to make it simple. Ray Dalio could make a Picasso painting out of your portfolio. He says that if you treat your investment approach like a Picasso career, you can make a lot of money. Picasso's early works were complex and outstanding figurative paintings, and as his career progressed, he simplified those works and became a trademark of international art galleries. As the years go by and you continue to invest, diversifying in a portfolio, it can be the simplest way to grow your money. Always shy away from unnecessary technicalities. Number 3. Be an open book. Before Ray Dalio grew his fortune, he had humble beginnings working as a caddy when he was just 12 years old. He learned one of his life's most valuable lessons working on the golf course. It is essential to listen. He continually overheard market conversations from the golf players around him, where he would base his first investment decisions. In a market full of opinions and predictions, being an independent thinker could help him avoid so much clutter. Bet against the consensus and start winning. Since the consensus is always baked into the price, Being painfully wrong is inevitable, and you will lose a lot of money in the process. Ray Dalio knows that, but you can get on the right path if you know how to fail with success. A shift in perspective could be all you need. Going from "I know I'm right" to "How do I know if I am right?" could save you a lot of money. Dalio always takes a second to see what piece of information he is missing, and if there's something that he doesn't know about a company. The billions in his bank account don't stop him from continually learning new things and asking for advice from his partners and friends. He always keeps an open mind, absorbs critical information, and has the amount of empathy that a well-versed investor should always have. Ray Dalio can take in different perspectives through the eyes of others and take many approaches towards an investment. We're talking about a market legend that manages over $150 billion. And he is still humble enough to listen to advice. Number 4, prepare for the worst. This is possibly one of the best rules to take in from Ray Dalio's approach. Before putting your money on the line, always expect the worst scenarios, so you can prepare mentally if something goes wrong, and it can. In his career, Ray Dalio has seen the worst crises the stock market had to offer. What he established is, actively think about the worst-case scenario and find ways to eliminate the intolerable ones. Once those are gone, you can stay in the game. For Ray Dalio, the most important thing is not getting knocked out of it. He learned that valuable lesson the hard way, back in 1982. The founder of Bridgewater made a mistake that almost cost him the entire hedge fund, all his money, and several clients. A bad bet on the market almost knocked him out completely. He was so broke that he had to borrow $4,100 from his father to pay his bills and sustain his family at the young age of 33. After such a traumatic event, Ray calculated how much his basic needs were and worked towards getting back on track, stashing as much money as possible so his worst-case scenario would be tolerable and not the end of the road for a magnificent career. And that worst-case scenario mentally helps him enormously to diversify. Number 5. Diversify. Ray Dalio has learned immensely from that almost broke experience. He learned the essential math behind diversification, and now he does it instinctively. Suppose he had a lot of bets from different industries that are not related to each other. In that case, one petrol company, one on technology, and another on the food industry. Those 3 are not directly related to each other. So it's a portfolio well diversified and reduces the risk by 80% without hurting his upside at all. Dalio explains with a great Chinese saying, "A smart rabbit has 3 burrows. If one gets dangerous, it still has the other 2. There are a lot of so-called fans out there putting all their money into one industry or company. When that company goes down, their entire portfolio goes down with it. So it's wise advice to diversify in different sectors. Number 6. Never react to the trend. Every investor should know that the market is not a 100-meter race. It's a marathon. Investors who stay for some years can call themselves successful. The gurus around the internet full of one-time triumphs that simulate winning millions overnight are not realistic goals to have. Besides, investing in such short-term investments can take a toll on your health. Many traders lose all their money overnight by exposing themselves to high volatility. Ray Dalio knows the market has its rules, and once you're in, there's no turning back. Many investors rush to buy stocks only when the price rises. It has been like that for decades. A mad rush for a rising stock could have a small upside with too much risk. And simply reacting to what others are doing is the best way to lose your money quickly. Ray Dalio always focuses on value first to avoid higher prices for FOMO. This means buying just for fear of missing out, a trait you can see in many bad investments. Only because something is trending today doesn't mean it will still be trending tomorrow. Ray Dalio always chooses to wait a little bit to find out if the stock is overpriced. Study the real value of it, and then decide if it's worth buying at that price. A little patience could take you a long way in any market. Number 7. Set your goal. Ray Dalio always visualizes a strong mission for his team while managing one of the world's most considerable hedge funds. This is because he understands the importance of having a common team mission. He likes to make reunions with his team while he visualizes amazing outcomes. And once everybody is on the same page, success will only be a consequence of teamwork. A team with long-lasting pillars, meaningful work, and equally meaningful relationships. What's your favorite rule from Ray Dalio?